everyone, this is Stephen here from Share Navigator, and I'm going to do a very brief tutorial on the bear put spread, and I'm going to demonstrate on the IG platform. So that's going to be beneficial for people in the UK and Ireland who can put on a bear put spread tax-free. The principles are the same, so for people who are viewing this outside of the UK and Ireland, you can do this in your interactive brokers account using MES or SPY or whatever you want to do. So what we're looking at here is a chart of the S&P 500. And the first thing I want to say about a bear put spread, the clue is in the name, it's a bear. We want the share price to fall when we put on a bear put spread in order to profit. And it's a low probability strategy. So usually at Share Navigator, we do high probability strategies, but every now and again, we shift our attention and we look at a technical setup and say there might be a reversal here and we think the market might pull back a bit, and how do we profit from that? So the good news about a bear put spread is that actually the amount of capital we put at risk is actually going to be quite low and our returns are going to be quite high. The downside is the probability is going to be low. In other words, you're not likely to win in this trade, but if you do win, you potentially could win big. So let me explain further. Let's look at the technical setup first. So why would we put the trade on in the first place? So here's a chart of the S&P 500. You can see back here, we put in these highs, and this is what we call potentially a triple top. We made a high, it kind of struggled to break it through it again, struggled again, and then it all of a sudden fell off. This is the war in Iran escalating. Then we have this rally here, this channel here, this short-term uptrend, which is basically predicated on talks between the US and Iran and Israel and Lebanon. And that's why you're seeing this series of higher lows and higher highs. Plus, we also have some strong earnings are after coming out as well. So all the fears of recession, the market seems to be discounting them for now. We're not saying that's not a possibility later on. It really depends how long oil prices stay elevated. But that aside, we're now approaching, as you can see, that's yesterday's trading, yesterday's close. So we're now approaching this triple top, which is significant resistance. So one of two things is going to happen. The S&P 500 is either going to break out of this resistance and create a new high, which is possible, or it's going to get rejected and it's going to maybe pull back a little bit. Okay. Now we're up towards the top of this bullish channel too, which is another resistance point as such. So that's why we're saying, well, maybe we're going to get a bit of a pullback in the near future, and potentially we want to try and take advantage of that. Now, typically, when you're looking to benefit from falling stock prices, people short the index. I don't agree with shorting stuff outright, because if you get that wrong, and the market continues to go on up in a big way, your losses can continue to mount. The other way is buying a put option, and that's where you benefit. If you actually own a put option, if the share price falls, you benefit, the value of your put option goes up. So think about it, it's like buying an insurance policy on the stock market. If the stock market falls, the value of that insurance policy goes up. But there's a significant cost to buying a put option. And that's where the bear put spread comes in. So the bear put spread basically alleviates some of that cost by adding another leg to the transaction. So we're going to show you what we're thinking of here. So we're thinking, do you know what, maybe there's going to be a bit of a pullback here. We're not ready to put this trade on yet. I want to see this test of the high here first. If it breaks on through, I think it might only break on through a little bit, and then that might be the opportune time to put this trade on. Or if it even touches it, I might put the trade on. Okay. So what we're looking at doing is buying a put option, and then at the same time selling a put option underneath it, and that reduces some of the cost of the initial put option. So what we're talking about doing is, let me just draw a line of where we're thinking about buying our put option or buying our put option. So we're looking at buying the put option at the 6,800 strike, so here. And then at the same time, we're going to come along and we're going to sell the 6,700 put option for April. So we're buying a put option here. So we're going to benefit on a fall if the S&P falls towards the 6,800 level. And then we're kind of putting a ceiling on our upside from this fall, because I don't think it's going to fall below the 200-day moving average. So what we're doing here is selling a put option at 6,700 to take in some premium. So one part of the trade benefits from a fall, the other part of the trade starts to lose from a fall. But because the strike price or the insurance price down here is lower, actually the gains from this will outweigh the losses from this one. And that's the whole idea of the trade, the bear put spread. Okay, so let me move on to the platform, show you how we place it. So we're going to go in here to the US 500 on the IG index options. So you click on options on the left, US 500. And we're going to look at the April 30th expiry, which is only 2 weeks from now. So this is a very, very short-term trade. So now if we go down to the 6,800 strike, you can see we're looking to buy the put option this time. So I want to stress that we normally sell put options, but because we're implementing a low probability trade here, we're actually buying this put option for the first part of the bear put spread. So you have to do this trade separately. So you have to do 2 trades separately. So you can see here the cost of doing that is 36.65 per point. So if we were to put on a bet size of 1, for example, this trade will cost us 36.62. You can see it changing all the time. That's all we can lose on that trade, okay? And if, for example, the S&P 500 fell 800 points, we would make $800. It's unlikely to do that between now and April the 30th, but we're just giving you an example. So by buying this, we're buying an insurance policy. And we're basically saying that we think this is going to fall in value towards 6,800. And as it falls in value towards 6,800, the value of this actually goes up and we get to sell it more expensively, okay? So for an account size of 10, and because we're up 9.2% year to date, we don't want to give away too much of those gains there. So we're going to limit our order here to a bet size of 6. So right now, if we were putting on this trade, we're going to spend 6 times 36.74, okay? And that will give us a cost there of just over $200, right? So we will have gone and placed that trade. That'll be done as a separate trade. So then what we would do actually come along in reality then, the next trade will be to take in some income to offset this cost here. We would sell the 6,700 strike and take in 21.77. So if you think about it, if we're paying out 36.74, taking in 21.70, that actually trade size is going to be limited to a bet size of 15. So we've reduced our cost from 36 all the way down to 15 because we've basically put a floor on how much we can profit from this insurance policy. So let's say we went ahead and placed that trade. There'd be 2 separate trades. Our cost is 15 at a bet size of 6 per point. So we're risking $90. What's our potential gain? Let me bring you back to the chart here. Well, if you look at here, if, for example, the S&P 500 fell down, I don't know, let's pick a number, magic wand stuff, to 6,500. Well, the value of that put option here would be 300. If you think about it, it's fallen 300 points. So if somebody, you're basically have insured it for 6,800, it's dropped to 6,500. So the value of that must be 300. Okay, so you're going to be up big on this one. 6 times 300 to be $1,800. Okay, but don't forget we sold this one at 6,700. That's going to be down 200. The difference between the strike and the current value. So it'll be 6 times 200 will be minus 1,200. So we will have made, or this position will have been worth 1,800 minus 1,200, which will be 600. Okay, now we think about the cost or the bet of that trade. We only invested $90 in that trade. So our actual profit on that would be 510. So it'll be 600 minus the 90 investment, which would be 510. So we're potentially risking $90 to make up to $510 in this particular trade. And that's the reason why it's low probability, because the market must start moving down here for us to profit from it. And then also, if it starts doing that, we win big. So it's a low probability, high reward trade. And the best thing about this strategy is we're not risking a lot of money on it. I'm capping my losses at $90. I can't lose any more than that. But potentially, I could make $510. That's the whole idea of this particular trade. Now, one thing we got to be aware of, let's say this trade doesn't go our way. I don't fancy losing my $90. I'm going to actually reduce that risk. And how I will do that is, if this starts to plow on through here, this trade will have two sides to it. The short put will start becoming very, very, very profitable, but this long put at the 6,800 strike will start to lose. What I will actually do then is close down the 6,800 side of it and leave the 6,700 on to expire worthless. And that will reduce our losses substantially, and we might even actually generate a bit of a profit on that. So just in summary, the bear put spread, it's a bearish strategy. We want the market to fall. The only reason we're putting it on now, options are cheap at the moment, is number one. Number two is the S&P is coming up against a significant resistance area. That doesn't mean it can't break above this area. Of course it can. If the news is positive, it'll drive on through it. But there's a probability that there's actually going to start pulling back at some point in time. So we want to put on a trade. We're not really confident enough to put on a really speculative bet here. So we're limiting our risk by putting on a bear put spread. And we're only risking 90 to make 510. And it's a combination of two options. We're going to do 6,800 is the long option. So we'll buy that put option. And then we're going to sell the 6,700 put. That's the short option. Okay. The net cost of the trade to us per 10K account will be $90. So that's a bet size of 6 on each leg. Okay. So if you had a 30K account, your bet size will be 18 and so on and so forth. Okay. If you're doing this on an interactive brokers account on MES, for every 10K, you would do one contract. 20K, possibly up to 3 contracts. There's a slight differential there, okay? But the numbers are the same. Probability in this trade, guys, is only 20%. So when you put this on, or if you do put it on, please note, you're unlikely to win on this trade. But if you do, you're going to win big. And all we're trying to do is say, look, we've made 9.2% so far this year. We're going to risk a small amount of that, 1% of it, to possibly make a significant gain on the upside on the account. So if we win on this, we're going to make a 5% return on investment on the entire account. On the actual trade itself, it's a lot higher. It's closer to 500%. Okay, this is Stephen with just an update on the bear put spread. I hope that makes sense to you. If you have any questions at all, please, as per usual, send me a WhatsApp and I'll be happy to chat with you. Thanks and bye for now.